Owner's equity is the residual interest in assets that remains after subtracting an entity's liabilities. Owner's equity includes contributed capital, treasury stock, preferred stock, retained earnings, accumulated other comprehensive income, and non-controlling interest. To learn each of these items, let's go through setting up a new company with just equity and no debt. At incorporation, a company should disclose the number of common shares that are authorized, issued, and outstanding. Authorized shares are the number of shares that may be sold under the firm's articles of incorporation. Issued shares are the number of shares that have actually been sold to shareholders. The number of outstanding shares is equal to the issued shares less shares that have been reacquired by the firm. So this company may, at incorporation, decide that there are 2,500 authorized common shares, of which 2,000 are issued to shareholders. The shares can be issued at par value or at a premium to par value. The par value of common stock is the stated value of the stock on its issuance. It has no relationship to fair value. Let's assume that the par value of each share is quoted at $1 per share, and the shares are issued at a premium of an additional $1. So in effect, the shareholders contribute $4,000 and the company receives $4,000 in cash. This forms the contributed capital amount under owner's equity. Contributed capital is the amount contributed by the common shareholders. So at this point, the contributed capital is $4,000 and the number of outstanding shares is 2,000. Let's say a while later, the company decides to buy back 200 common shares from the shareholders at $3 each. These 200 common shares become treasury stock. Treasury stock is stock that has been reacquired by the issuing firm but not yet retired. It has no voting rights and does not receive dividends. So in this case, the number of outstanding shares dropped to 1,800 and the contributed capital is reduced by $600 to $3,400. Say the company now decides to raise additional capital through preferred stock. It issues 1,000 shares of preferred stock at $3 each. The company receives $3,000 in cash and $3,000 preferred stock is created under owner's equity. Preferred stock has certain rights and privileges not conferred by common stock. For example, preferred shareholders are paid dividends at a specified rate, usually expressed as a percentage of par value, and have priority over the claims of the common shareholders in the event of liquidation. There are instances when preferred stock is classified as debt instead of equity. For example, preferred stock that calls for mandatory redemption in fixed amounts is classified as debt. When the company makes money, the net income as reflected in the income statement can be distributed to common shareholders as dividends, with the balance going into retained earnings. Retained earnings are the cumulative earnings that have not been paid out to shareholders. In this case, let's say the company makes a net income of $1,000 for the year, of which $400 is paid out to common shareholders as dividends. The remaining $600 goes to equity as retained earnings. Other comprehensive income are special transactions that are not reported in the income statement. However, such transactions still affect stockholders' equity. Unrealized gains or losses from available-for-sale securities is an example of other comprehensive income. For example, this company uses $600 to buy shares of another company and classifies them as available for sale. Let's say the market value later triples. There is now a $1,200 unrealized gain. This is not reflected in the income statement, but it is reported as other comprehensive income as this affects stockholders' equity. And finally, minority interest is the minority shareholder's pro rata share of the net assets of a subsidiary that is not wholly owned by the parent. So, for example, let's say the company acquires a controlling 60% stake in a subsidiary, which has $4,000 in net assets. The company pays $2,400 in cash. Under accounting rules, the entire net assets of the subsidiary is reported in the company's balance sheet. However, since the company only owns 60% of the subsidiary, the remaining 40% is reported as minority interest. The statement of changes in stockholders' equity summarizes all transactions that increase or decrease the equity accounts for a period. We shall illustrate how this statement records the changes that brings this company from zero equity to what we see in the current balance sheet. $4,000 worth of common stock and $3,000 worth of preferred stock is what was issued during this period. Within this period, $600 was used to repurchase 200 shares of common stock. This is a reduction of stockholders' equity. From the income statement, the company earned a net income of $1,000. This goes into retained earnings. Outside the income statement, there is a $1,200 unrealized gain from appreciation of the fair value of available-for-sale securities. This amount is considered other comprehensive income. $400 cash dividends was paid out to common shareholders. This is a deduction from retained earnings. And finally, a 60% stake in a subsidiary was acquired. As the full net assets of the subsidiary goes to the company's balance sheet, $1,600 of minority interest is created to account for the 40% stake the company does not own. Adding all this up, we get the ending balance of a stockholder's equity. The amounts here should correspond with what is shown in the balance sheet.
You're watching an excerpt from our comprehensive animation library. For more videos like these, head on down to prepnuggets.com. At Prep Nuggets, let us do the hard work for you.